Hang Seng is higher by 2%. Nikkei also higher by 2.3%.
For the Nifty, the low, which is 19,333, is the sacrosanct level, which should not break.
Just going by all the cues you have, and hopefully there is de-escalation that we see in Israel, then in fact maybe today is a good day to get in at lower levels.
Escorts is in focus. DAM Capital actually raised their target price on Escorts quite substantially. There we have it, 65 points in the green for the Nifty.
And in the light of where US 10-year government bond yields are trading, Indian government bond yields of a similar tenure are on the lower side.
So I'm looking at Genus Power. Now they won 2 orders worth 3,100 odd crores.
This quarter, as you rightly pointed out, we are penciling in a 21% earnings growth on Nifty.
They say the company is well placed to post a 12% volume compounded growth over the next 2 years.
Global rebound has taken the Indian equity markets higher.
Hundreds of locations in Gaza have been targeted by Israeli airstrikes.
For the markets looking good, reversed most of the losses that we saw yesterday.
Hello and welcome to Closing Bell. I'm Naishal D'Souza, and joining me from the studio, Rima Tendulkar, we have Surbhi Upadhyay, as well as Prashant. Today has been a good day, and as you heard in that wrap itself, earlier today, when we were around Bazaar itself, we said it had the makings of a very, very good day. And that's precisely the way it played out, because overnight, the US markets rebounded, the yields cooled off, the dollar index as well cooled off, and in fact, the commentary coming in from the Fed was fairly dovish in comparison to what we've been hearing of late. So it's a good move on the Nifty, which is up close to 200 points. But the reason that we have seen a big move today is because the banks have come back, and the banks have come back in style. Remember, in the past week as well, the banks were relative underperformers, but today it's up close to around 1.3%. And after a while, we're seeing that the Nifty bank, in fact, is outperforming what the Nifty is doing. And take a look at the breadth of the market. What makes your portfolio feels good is when the number of stocks advancing are way more than the number of stocks declining. So they've got a little closer as the day progressed. At one point of time, we had close to around 8 stocks advancing for one stock that was declining. That's come down a little bit, but still you have more than 2,400 stocks that are advancing and just around 600 stocks that are declining. Pretty good times. Just hopeful that de-escalation in Israel, for the good of humanity, for the good of the economy, and the good of markets as well. We just pray and hope that we just see de-escalation in Israel. Guys, what else?
Indeed, the death count there is mounting. I think last we read was close to about 1,600 people have lost their lives in the skirmish. But investors at least appear to have made peace with the conflict taking place between Israel and the Hamas group. The Nifty is building on gains. In the morning, it spent a lot of time around 19,600, and now it's conquered 19,700. So going from strength to strength, and that banks outperforming today is also the Fin Nifty expiry. Just a quick word on 2 or 3 stocks. Metals have started moving up. Pull up the intraday chart of Hindalco. That's up 2.7%. Tata Steel has rallied 1.5%, and JSW Steel too has moved at the high point of the day. The representative of that is the Nifty Metal Index. Well, there was an article which was quoted in Bloomberg where China is considering raising its budget deficit for 2023 as they prepare a new round of stimulus, and that seemed to have boosted the sentiment, at least for the metal index. So that's been, the place where investors are latching onto right now.
Oh, absolutely. Suddenly, when there's a lot of green out there, the European markets right now are doing very well. In fact, gains on European screens are in excess of 1%, depending on which one you're looking at. Most of these markets are rebounding quite nicely. We've got oil, which has been holding steady, about 88, so not much has moved there. And if you're looking at the indicators you're getting from the U.S. market, chances are we'll continue to see more of this when U.S. opens up as well, because most of those futures, at least, are pointing to the north side, the upside. The talk also is, of course, on the bond markets as well. Right now, if we look at the U.S. 10-year yield, it's quite steady at around 4.65. So the question is have we really seen the most of this big yield scare play out? Have we seen the peak, at least in the near term, in the here and now? Well, this is a question that Prashant has been looking at in a lot of detail as well. How these U.S. yields might actually behave. Prashant, take it away.
Well, thanks very much for that. If you remember exactly a week ago, actually not even a week ago, we had put out a piece which looked at, the previous very large spike in U.S. government bond yields. And when these kind of spikes happen, what happens immediately after, right? And what the data had shown in that piece was that you basically see almost 30% retracement of that entire rally. So, for example, in this episode, we've seen a 100 basis point rise in the last 3 months. You see at least a 30% retracement, all the way up to 50%, in some cases even more. Is that what is playing out, right? That's the question. Now, prices lead and reasons follow, as we all know, as far as markets are concerned. But this is the argument which bond markets seem to be latching on to. And the argument is being voiced by Fed officials. That is what is new. That Fed officials, one after the other, in the recent last couple of days have come out and said this. So the argument is this, that we've seen a 100 basis point rise in US 10-year government bond yields, in 3 months flat, which basically is nothing but financial conditions tightening, right? These are market interest rates that we're talking about, and they are going up. Even if Fed is not moving, market interest rates are moving up, which would be welcomed by the Fed, since it kind of is doing their job, which is, hiking interest rates to control inflation. So it kind of keeps a lid on what the Fed needs to do in terms of further interest rates. Maybe they can be on hold, right? This is especially relevant because the last jobs number that we got was a blowout number. Let's just actually tell you, the reason we are talking about this now is because Fed officials themselves are voicing a lot of this. And I just want to put out a few Fed officials and what they said. This is the Dallas Fed chief, who basically said if long-term interest rates remain elevated because of higher term premiums, there may be less need to raise the Fed funds rate. She went on to say if the rates go up because the economy is continuing to do very well, then it's a different question. But that's one. Number two, you had the Fed vice chair just last night saying that I will remain cognizant of the tightening in financial conditions through higher bond yields and will keep that in mind as I assess the future path of policy. Number three, you had the San Francisco Fed's chief who said, likewise, if financial conditions, which have tightened considerably in the past 90 days, remain tight, the need for us to take further action is diminished. All we now need is some of the more influential Fed members starting to weigh in. Will Fed Chair Powell himself say something around this subject? It's possible, right? And that will kind of really seal the deal in terms of what the next move from the Fed is going to be, which perhaps could be just a pause. There are a couple of data points which I think are important. Tomorrow we'll get the Fed minutes, so we'll get to hear some more of their thinking. And then on Thursday, that is a bigger one, because there was disbelief. The headline number, the jobs number was such a massive beat, while the detail was soft. So I think the CPI number will be important to set the course in terms of what markets should expect from the Fed going forward. So as I said, prices are always up in front and reasons follow. The reason nobody could have expected, right? But it's also being debated right now, this sharp fall in yields that we're talking about. And by the way, we're talking about implied fall in yields because markets have bond markets are not open since this weekend crisis in the Middle East. They'll open for the first time, but the implied open is sharply down as compared to Friday's close, more than 10 basis points. It was 16 basis point fall in the morning. That's kind of come off a little bit. But I think we'll need to watch the direction from here on. Probably, we are resetting lower, and I think that'll be good for financial markets everywhere. Back to you.
Thank you very much, Prashant, for putting that in context. Back to our own markets. How should you position yourself in the last hour of trade? Mitesh is back with us. Mitesh, is this a lot of short covering that we are seeing at 19,700? And your expectations from the last 1 hour?
Good afternoon. See, I'm not sure whether it's short covering because I look at the futures and options data towards the end of the day. But I think, we've been advocating that the decline could be over and we might just chop around between 19,725 and about 19,500 to about 450 on the downside. Now, the key here would be getting past 19,725 and giving an hourly close above that. So I'm waiting for that. We've taken some long positions in the morning. We've booked on the stock side as well. But now hoping to see if we can see a breakout beyond these levels. So for the time being, I have some stock calls. City Union Bank is having a very strong breakout. So that's a buy with a stop below 130. Targets are 142 here. And Chambal Fertilizer similarly, that's a breakout buy as well. Keep a stop at about 278 and a target of 295 can be looked at.
Okay, Mitesh, got that. Thank you very much for those trading calls. That is Mitesh with a couple of picks. We'll come back to you, Mitesh, in about half an hour, get some more going. But let's look at stocks that are active today. And the one that's topping the Nifty chart is actually Coal India. Stock is up. Wow, look at this. Another 5% up on Coal India after what has been a pretty good rally. Last couple of weeks have been pretty steady for the stock. Pull up a 1 year. And this PSU, along with a lot of others, is also up in about 30% up, I think, over the last 1 year. Let's take this to Nigel. Nigel, I remember Nuvama writing on Coal India. What are they saying and what's their view?
Well, Nuvama was asked as positive on Coal India. They've gone ahead and increased their target price to 385 rupees from around 361. Their EBITDA estimates as well, they have increased it by around 8 to around 9%. Couple of factors that are playing out. One is they're factoring in higher e-auction prices as well as higher volumes. And the key factors that they've broadly stated is they're saying it's right for good amount of volume growth. They're factoring in around a 6% CAGR in terms of volume growth from year on, and they're talking about 827 million tons by between now, that's FY23 to around FY26. They're also saying there's a possibility of the highest possible dividend that we see in the second half of the year, and they are factored in for the year around 30 rupees and the next year around 25 rupees. They also say e-auction prices are improving. They go on to state that demand for thermal power is set to increase in the second half of the year. Why is that? Because the monsoons have receded, and also from renewable energy, whether it's hydro or wind, the generation has been falling a little bit. The other factor that they've highlighted is the e-auction premium. Remember, it had cooled off during the monsoon season to around 54%. That's in the month of June. But now for September, it's back at around 106%. E-auction, remember, is bulk of their profitability, so they like that. And the reasons for the spike in e-auction prices they've given, one is the spike that we've seen in prices globally. And the second factor is the uptick that we've seen in industrial activity. It seems the street has taken note of this Nuvama note. Explains why the stock is flying away up more than 5%. Deepak Shenoy joins us as well on the show. Deepak, well, one would have thought at 200, 250, maybe the run in Coal India is done. Maybe at around 280 rupees as well. But the stock doesn't stop, right? Valuation comfort has always been there. But it seems the ESG fears that were earlier there, they seem to have receded because the globe is coming to terms that coal is still have a few years before we move entirely to renewable energy. Your take at around 300 rupees.
Hi Nigel. Firstly, ESG I think is kind of like a scam that's been placed on all of us. In the end, using that to differentiate between companies when you can't obviously get rid of thermal power in any meaningful way. I think that is just canary in a coal mine, if you may. But I think the problem right now is to assess about how much it can go. It's been at 450 in the past. It's not at that time been as profitable as it is now. It just gets a much lower valuation because people assume that it's not going to last. The discounted cash flow of the future is going to kind of get cut off at some point. I think it'll stay as a business for a really long time, even now. However, it's a commodity, so you shouldn't expect that it will grow tremendously. It's just more a value, a dividend, and cash flow kind of a play. You'd value it primarily based on interest rates, and your discounting rates keep going up if interest rates go up and if discounting rates go down. So in a lower interest rate period, you value this company higher. But overall, I don't see this as a brightly growing business. It's a great play for long-term dividend. It's probably the best, a better way to get dividend, if you're a longer-term player, even now. But beyond that, I won't, consider it as a serious growth play.
Deepak, wanted to get your thoughts on jewelry companies. Now they've surged in trade. You're seeing gains of close to about 6%, even more than that, in names like Kalyan Jewellers. Mangalam is here to tell us more on what could possibly be fueling this rally that we're seeing in these stocks. Mangalam.
Well, a bunch of stocks are moving in today's trading session, the jewelry stocks that we're talking about. But it's not just been today. If you look at the last 3 months' moves itself, from Senco Gold's listing, the stock is nearly doubled. A 95% move is what we've seen there. Thangamal Jewellers is up 60%. A 45% jump is what we've seen in TBZ. Kalyan Jewellers that you spoke about has been actually among the lower performers, in the last 6 months with a gain of just around 44%. And Titan too has been among the underperformers with a gain of just about 8%. But over the last few days, there could be a couple of reasons why these stocks are moving higher. One, there has been a strong update coming in from both Kalyan as well as Titan on their second quarter, and this at a time when the street was anticipating the second quarter to be actually weak because of the Adhik Maas factor. So domestic business for Kalyan grew by 32%, for Titan as well grew by about 20-odd%. Then the street was expecting some subdued performance during the Shraddh period, which is currently on. And this Saturday itself, the Shraddh period ends. So the street is expecting strong demand to come back in the festive as well as the wedding date season as well. And importantly, this morning we also got the news that an Ahmedabad-based RBZ Jewelers have gotten a SEBI nod for an IPO. So every time there is an IPO in the sector, all the other listed stocks do get excited. Having said all of this, Senco Gold, when it was offered for an IPO, it was offered at around 14 times one-year forward earnings. Now it's doubled and it's at par with all the other companies, the likes of Kalyan Jewelers. Thangamile, however, is still lower at 16 times one-year forward.
Okay. Got that. Thanks very much, Mangalam. Interesting analysis there. At least I think when it comes to listed jewelers, all that glitters indeed is turning out to be gold, irrespective of the size of the market cap you're looking at. Deepak, hi, good afternoon. Are you buying any jewelry this festive season or jewelry stocks? Or is it too late to buy the stocks, so you'd rather buy the jewelry?
Actually, I don't buy either. I haven't done that for a long time. I don't really understand some of the valuations here. I mean, irrespective of where they are, it's just that it's a very difficult. I mean, I think the more easy to understand is the retail jewelers, the guys who primarily like Titan, for instance. But I think it's a investment plus consumption kind of a play. A large amount of it is related, to economic factors on the macro level. So it's kind of surprising that it's happening now, but in the sense that the economy has been doing well. So I think that kind of reflects in the valuations, but there will be cycles of up and down performance, and then there's a gold price to go with it. So you attach all these factors, they don't give us a whole lot of confidence on growth. A large part of which is related to gold prices, though they do tend to hedge a little bit. I'm not very excited. And then there's been a lot of bad players in this sector. People who have, companies that have been caught at a much later date. Whether it was Gitanjali Gems or whether it was a bunch of others. There is just too much invisibility in the sector. Nothing to say against any of the current companies. I think they're all probably in good hands, but I would say I don't understand the sector enough to be able to take a call on it.
Well, right now, at least, retail consumption has been high. Kalyan reported a 32% jump in their revenues in Q2, while Titan, in its business update, spoke about a 20% top-line growth for the company. Deepak, do stay on. We need to get into a break. On the other side, we'll also be joined by Aman Chauhan, fund manager at Abacus Asset Management. Welcome back. City Union Bank is surging in trade on the back of a brokerage note. Abhishek joins in to fill us in with the details. Abhishek.
Well, it's a sales note coming in from BNK Securities on City Union Bank, wherein they have a buy recommendation and they say that there is upside potential of 50% on the stock. So it's an SME specialist which is in the last lap of his asset quality cleanup. So they are saying that, the stage is being set up for a sustained turnaround in earnings trajectory. So net interest margin in Q2 will expand by 5 to 6 basis points and asset quality will improve in Q2 FY24. So business turnaround is nearing the completion stage and the stage is set for a good turnaround or rebound in loan growth and profitability as well. So they expect the re-rating in valuations by almost 50% to price to adjusted book value of 1.5 times from the current level of price to adjusted book value of 1 time. So Q2 FY24 will demonstrate ample clarity and confidence on growth recovery that the management will show and also the asset quality stabilizing. So stock in terms of valuation is at the bottom end of its trading range in last 3 years. Back to you.
Okay, thank you very much for that. Deepak, as Abhishek was pointing out, that the valuations are fairly attractive at the bottom end of the cycle and much lower than peers. Would you bet on City Union Bank?
It's been a disappointing stock in the past. So the other thing that's going to happen now, I think, is also a little bit of margin compression from a NIM perspective. Just simply because rates have gone, the liabilities have been repriced now versus earlier. Asset repricing was earlier. I don't think there's a major problem in their asset book, but I just think growth has been a concern in the past. The management has not been so aggressive, but recently there have been some slight changes. I'd wait for results, I think, before we come out. I don't know when the results are, but in general, I think banking results will have to be seen as a whole, and then which individual players shine. City Union, we have owned it in the past, but it's been a long time since we've owned it. But we'll look forward to it once results come. But I won't take a call before that. I think I have to wait for the margin impact before we take a call.
Okay. Let's look at this real estate rally that's been playing out. Quite a few names there. Quite a few of the companies are actually based in and around the area where our guest is from. I'm looking at some names. Of course, Godrej from the Mumbai space, actually pan-India now, 6% up on that stock. This Prestige that's holding on to a gain of almost 9.5%. Puravankara is up about 10%. Huge moves on some of these real estate names today. Let's first look at the recent updates that have come in, quarterly updates, and we'll ask Deepak what he's doing with these stocks. Sonal, take it away. Tell us about how the numbers look this time.
Oh, it's been very strong. And look at Nifty Realty, right? 4.5% higher. It's a record high for that index as well. And that's what we are seeing for some of these stocks as well. But let me start with individual names. For instance, Keystone Realtors. It has been a good update, especially on the collection side, which is also very important for real estate companies. Their pre-sales volumes are down 45%. Pre-sales values down 33%. However, collections are up 70% on a YY basis. The company says that they've completed 5 projects having construction area of 3.12 million square feet, and they've also added 4 projects with a gross development value of 3,644 crore rupees. They remain confident on achieving their guidance on pre-sales for FY24, and in the first half itself, they've seen pre-sales growing by 13%, collections going higher as well at 1,080 crore rupees. Area sold has been flat on a YY basis. Phoenix Mills. Now, let's talk about the 3 segments. The mall business is the biggest one, and that's where they've seen their retail consumption growing by 20% on a YY basis. Their retail collections have also gone up by 23% to come in at around 640 crore rupees. The residential business, which is not so big, has still done really well. A 200% jump in their pre-sales, and they say that the demand continues to be very strong. Their hotels business has seen an increase in their average room rentals in the first half by 32% in their Mumbai property and 13% in their Agra property. So looking good for Phoenix Mills as well. The stock is higher in trade. The third one is Puravankara. A strong update coming in there. Value is up 102%. Volumes are up 89%. They've also been able to take a price hike, so realizations are up 7% on a YY basis. Ajmera Realty is the fourth one that I'm focusing on, because their sales value is up 52% and their volumes are up 51% on a YY basis. So across the board, beat any market, updates have been strong, and so has been the commentary.
Okay, all right, got that. Sonal, thanks very much for a quick roundup. Those numbers looking quite good. So, Deepak, it's the same dilemma, right? I don't know what's cheaper or what's more expensive, buying a house in a city like Bombay or buying the stocks in terms of valuations. But tell us, it's been a breathtaking real estate rally. What would your sense be? And, would you look at buying anything afresh now?
It's been quite interesting. I think buying a house is great if you want to live in it. It's not so great an investment, but then, the market seemed to be telling us otherwise. There is definitely a lot of interest. We're seeing this in Bangalore as well. I don't know about Mumbai, but I know that in Delhi also, sales continue to be strong, at least pre-sales or whatever they call it in that place. So there is a lot of interest in Bangalore, a lot of end user interest as well, and to the extent where you're going to see the local government actually increase the base rates for registering properties to be able to earn more taxes. So I think while you had a pocket of about 1.5 years of lull in construction, that created a bit of a supply gap. And when demand has come, there's not enough supply to meet that gap. It takes 2 or 3 years to build something. So you're going to get some price escalation, some demand, and some, fear, greed kind of movement. I think this will slow down next year. So in general, in a slowdown, real estate companies are worse to hold than the houses themselves. At least you can live in the houses. What do you do with the shares? But the other point is, of course, that, the companies themselves tend to take their good times and invest all the free cash flow that they make in such times into other pockets of land, which does not generate returns for shareholders for really a long time. So I think at this point, if you want to get into real estate, it would still be the Godrej's and the Oberoi's that might be the better picks here. Although a lot of price strength in DLF and a lot of price strength in some of the southern-based Soba and Prestige as well, I personally would say, the better, the players that have stronger land prospects and, and stronger balance sheets are the ones to go with. I simply put them in a pecking order and buy them. We don't have any of them right now. I think we'll consider them after results this time. Results usually for real estate companies have to be, analyzed more deeply because of all the Ind AS standards. They tend to ruin their cash flows, and they don't release cash flow statements every 6 months. So we have to make an estimate of those cash flows using the balance sheets.
Okay. Deepak, we'll leave it there. Thank you very much for your time. Great speaking with you, as always, here on CNBC-TV18. Aman Chauhan is also with us, fund manager at Abacus Asset Management. Aman, good to have you with us here. Thanks, as always, for joining us. Actually, I want to pose that question, real estate, to you, which we were just discussing with Deepak. What are your thoughts? It seems like a fresh move backed by huge volumes. The index is up 5%. It's almost as if, someone is taking a fresh view of the longer-term opportunity of the sector. But is that so, or is it just the pre-quarterly updates which is kind of adding to it? What's the sense?
I think it's a combination. The stocks have not moved for a good amount of time and kind of a catch-up rally. The sector anyway is doing well, right? So it's a 3 to 4 year cycle. We are probably in the second year of the up cycle. So we have another good 2-3 years of cycle to play. Plus, the view remains that sooner than later, we'll have the first round of rate cuts also coming in, if not immediately, maybe in the next 6 months or so, which will also give a further boost to the sector. And hence, the rally. And that's typical in bull markets. Every day, there is some sector which does well. Today seems to be a real estate day.
There is a lot of churn taking place, particularly in the mid-cap space. And today's flavor is clearly real estate. The Nifty Realty Index is, by the way, at a 15-year high today. But, Aman, we were chatting with another fund manager, and he said that he expects real estate to be quite the compounder. So a volume growth of about 8 to 9% every year, and add to that 7 to 8% price appreciation. So according to him, real estate could give you, earnings growth of close to about 15% from here on. So we're not, closer to the end of the cycle. He believes there was some more steam left. But you want to fill us in on some more changes that you've made in your portfolio since, there is that churn taking place in the markets?
repeat, yeah, the assessment is right. There will be volume growth. The companies can steadily grow. What I was mentioning to the real estate prices. So we have seen that every 4-5 years there is some price correction. So it cannot happen that every year for the next 10 years or so there will be a 7-8% price inflation in real estate prices, right? So there is a time when housing prices correct or stagnate in many times. So that is what I was referring to. On the portfolio front, frankly, not much of changes, especially in the last month or so. We have been on the sidelines. We were adding more of what we already own rather than buying new names. There have been some IPOs that we have invested in the last month or so. Besides that, not much of churn. Specific to real estate, as always, we don't have a direct real estate exposure. We play this upcycle through the ancillaries. So we would have laminate companies, plywood companies, MDF companies, tile companies in our portfolio. So that's the way we are capturing the real estate upswing in the portfolio.
Aman, hi, good afternoon. I recall you have a fair amount of mid-cap exposure as well across the portfolios, right? So just wondering, in this consolidation patch, which we hit soon after touching 20,000, have you been taking profits anywhere? And if yes, which are those areas in your portfolio where we've been partly sort of unloading?
It's more stock specific than a mid-cap or a sectoral call. So wherever we have seen stock prices move up too sharply, or wherever the exposure limits has gone beyond what our comfort level is, we would have trimmed our exposure. So typically we have a rule that single stock will not exceed 10% of the portfolio. If something goes around 8-9%, we start trimming that name. So that has happened in the last few months.
So, Aman, okay, let me rephrase that question. I mean, you don't have a sectoral approach to that in your portfolio, but generally, if you were to advise someone looking at, how the market is positioned right now, which are the areas where you think that themes have kind of run their course, at least in the near term, and some profit taking could be warranted? I mean, I don't know whether it's let's say PSU stocks or defense or anything else, or real estate for that matter. Anywhere where you think people should start booking some profits?
Clearly, defense and railways, these are the two sectors that have done extremely well in the last 6 months, and prices have almost doubled, tripled for most of the names. So clearly there is some fraud there. One needs to be careful, and wherever you don't have a valuation comfort coming in, some amount of profit booking can be advised in these two sectors. Besides that, in the next few quarters at least, chemical sector is going to be volatile. So if something which is quite expensive and there's margin pressure or growth not coming in due to the global factors, and this is something which can get derated. So there is always this risk in the chemical sector, and some pockets of pharma also. There can be some derating because in the near term, numbers might not come in as strong as what the street is estimating. Financials, we are pretty comfortable. IT, we are pretty comfortable. We feel the quarterly numbers are going to be good or better than what the street is estimating for IT as well as for financials. And that's where I can say incremental money for us is going.
All right. Hi, Aman. Good afternoon. Thanks so much for joining. And, to the point on real estate, China is going to a crisis in the real estate market. And over here, our real estate market is booming. So another point where we stand out in comparison to China. Pretty good going for us. But the other point that concerns China and obviously has repercussions for the rest of the globe is the metal space. And you all have made some perfect investments out there. The one that comes to mind first up is Jindal Stainless, where you all did quite well. You all got in at a very good time, and that's more than a, I think, 5-8 bagger for you all. But what's your positioning now on metals? Domestically, we're likely to see a fair bit of activity on the construction side, which some metal stocks will obviously be in focus. And also globally, China is talking about stimulus. Maybe the steel production slows down for the remainder of this year. How are you all positioned out there? Metals as a percentage of your portfolio, how much is it?
So we are positive on the space, but at the same time, it's not that we have a very large exposure to metals. In my portfolio would be anywhere between a high single-digit kind of exposure. In one or two portfolios, it could be 11-12%. But we have kept it limited because ultimately it's a global cyclical sector. So the stocks that we have picked are all bottom-up stocks. They all have an individual investment positive or investment thesis to go around as to why we have invested. But it's a global sector, and hence we wanted to keep a diversified portfolio. Hence, it's a high single-digit exposure for us. It has always been the case. Even 2 years back, this was the case. Even now, that's the case. So no material change in stance so far for the sector.
Okay, got it. Aman, anything new you've added in the portfolio since we last spoke?
IPOs. So it's public news. We have 2-3 IPOs that have come in the last month or so where we have invested. That would be the new additions in the portfolio.
Talk to us about one of the names, just for educational purposes. What you liked and, what was the thought process?
So we invested into sari retailing company, which just got listed. We were one of the anchor investors there. Then we invested into it. Yeah. Then we invested into an EPC company. This was a new IPO that came in. The stock got listed, I think, 2 weeks back. So we invested into that. There was a IT product or a quasi product company which just got listed 10 days back. We were invested in that also. So these are the kind of new names that are coming to the portfolio.
Sorry, the last one, I got one. There are so many IPOs that I run the risk of getting
We're all
names
trying
wrong.
to guess someone, but not quite sure.
Is the third one Zaggle? Sorry.
Zaggle, yeah. So we were anchor investors in Zaggle also.
And which was the EPC company?
EMS.
EMS, okay. And they've all done very well since they've sort of listed. So congratulations. My question actually is, there are two. And just talk about the company and what you like. It's not a recommendation to buy or anything. Sai Silk, which is Kalamandir. When we had the management right here in the studios and we spoke with them, one of the things which generally the worry was that it's in a way commoditized kind of business, right? There is no more. I mean, when you talk about saris, you talk about Banarsi sari or a Kanjivaram sari. You don't say a Sai Silk sari or XYZ company. I mean, so or is the call that we will get into brand building in this area as well? I mean, if you can talk about that, and then a little bit about Zaggle after that. Go on.
Because I can't discuss stock specific. Broadly, I can tell you that at a sectoral level, your assessment is right. That it's not a branded sector, and that is what the opportunity is. So I'm told that the organized market is not even 10%. So there is a decent chance that for the next few years, the organized retailing will pick up in this segment also, and they'll gain market share from the unorganized. And then that happens, the companies in the organized space can easily double or triple their turnover. So this happened with many other sectors. Shift from unorganized to organized, and there's no reason why it shouldn't happen in this sector also. The IT company is also a great business. So as we like in IT, it's a scalable business model, not capex intensive. You can grow the business rapidly without much of capital required. You throw free cash flow, you have decent margins, you have a decent moat. And the common factor between all these IPOs that we are discussing is that they are offering a good blend of growth as well as value. So I'm not overpaying in any of these names that we have recently invested. So we are pretty cautious about that market is at the high. At the same time, we should not get carried away. And my value conscious approach towards investing stands out. So these were the opportunities that we saw, decent companies, decent growth at a decent price. And that's what the common factor between all these names would be.
For both these companies, where should they trade? Is there a comparable kind of what would you be willing to pay? Or I mean, obviously you bought because you saw value, but what are fair valuations? P multiples basically for both.
Broadly, 1 to 1.5x PEG is what we look at. If the company is growing at 15-20%, we don't mind paying up to 25-30p for that company, but not beyond that in most of the cases. So that's what the comfort zone for us would be, a peg of 1.5.
All right. Thanks very much, Aman. A great conversation as always. Thank you very much for your time. And, absolutely take that point. Well, 178 on the Nifty, so it's looking very, very strong. Just under 19,700, 19,692 is where the index is at. We'll take a quick commercial break here. We'll come back. We'll get you a quick check on what's happening in dealing rooms. Nimesh, of course, does that for us. So that's lined up. And after that, a quick near-term trading ideas. Stay with us.
Welcome back. Well, it's been a good session, but some bit of selling pressure towards the end of trade. So we have come off closer on 25 points on the top. Just pull up the Nifty intraday chart. That'll, tell you the picture. We've come off 25 points. A good session nonetheless, but we're just trading below that 19,700 odd mark. What's heartening though is the breadth of the market, which is looking absolutely fantastic with 2,400 stocks on the advancing side. But it's that time of the day where we shift focus to D-Street chatter. Nimesh joins us to tell us what is he picking up. Nimesh, a good session, right? I mean, the buy on dips has worked out, and the markets are holding quite strong.
And actually, the good part about today's pullback is this is backed by FI buying as well. Oh. That's a big difference. Yesterday when we spoke, same time when we spoke about markets falling, the feedback was that the FI selling was not large and the DIs were big buyers, and that showed up in the numbers as well. Today it looks like both the legs are going to be buyers. That's the overall feedback. In fact, there is a market at close basket buying as well across multiple names at a leading FI desk. Even that could probably show up in today's numbers. So that's the first feedback, that today's big rally is backed by institutional buying. So that's one thing. Secondly, I guess even from a broader market, the pullback seems to be quite strong. And actually, we've recouped all of yesterday's losses, right? Not only the Nifty, but in the broader markets as well. And look at broader markets, the PSU banks, PSU stocks, metal names, even the real estate stock, the entire real estate pack is buzzing in trade today. That shows the momentum is clearly back in the broader markets as well. I guess technically also 19,400, 19,450 is acting as a very strong support, but now we are closer to that upper end of the resistance. So 19,700, 750 is a level to watch out for. If that gets taken out on the upside, maybe this momentum can continue. So one, today's rally is backed by institutional buying, and two, the momentum seems to be back in the broader market.
Well, the 20 DMA, 19,770, we can get past, that'll be good. And today it's good to see the big gun is firing, the Nifty Bank after a while. True. But individual stocks, what are you picking up?
A lot of names today. In fact, I was struggling to clear a few names not to add to it. So I'll mention 4 names. The first stock on my list today is Indus Tower. The stock is buzzing in trade today on good volumes as well. But I believe there is going to be a large block in Indus Tower very soon. So that's something to track going forward. So that's the first one. The second stock is Birlasoft. The entire IT pack seems to be back on the radar. The expectation is that most of the companies will report strong earnings. And for Birlasoft, there is buying interest, and the street is expecting a strong quarter this quarter. So that's the reason why that's buzzing in trade today. The third stock is Max Healthcare. Been consolidating in a narrow range of late, but I understand at these levels some bit of institutional interest is back. In fact, there are some block bids which have been indicated by leading long only funds. So there is interest back in Max Health is the overall feedback. And the last stock is J&K Bank. I've added to the list largely because while the stock isn't buzzing off late, but the first time there are some signs of some institutional interest back in this particular stock. So there are strong volumes for the last many days. Even in today's trade, expect high delivery volumes, and some bit of institutional interest is back in J&K Bank as well.
Okay, got that. Thanks very much, Nimesh, for the details there. By the way, CNBC is reporting that one of the members of the European Central Bank has said that more rate hikes are still possible if new shocks emerge. This is the Australian Central Bank chief, Robert Halsman. He was in conversation with CNBC Europe, and that's why he made that statement that if all goes well, rate hikes will come to an end. But given geopolitics, other situations, circumstances, more rate hikes are still possible. Right now, markets are not too perturbed with those comments because Europe is still up. As we can see, CAC, they're up 1.5% nearly. So it's a good afternoon across, or rather a good morning across most of the European indices. Back to Mitesh then to figure out what the final trades could look like. Mitesh, it's been a good day for the bulls. What's your final advice now?
So I'm suggesting a couple of BTST calls. I think HDFC AMC has moved on to day's high. So recommending a buy here with a stop at 2,740 and a target of 2820, and a BTST on BHEL, which I would recommend taking a long position on a BTST call with a stop at about 129.5 for target of 134.
Okay, thank you very much for that, Mitesh. LIC is the stock on our radar. It's lost market share. Yash joins in to tell us what's been happening at LIC and what the numbers look like.
Well, Rima, not just the market share. Look at the kind of premium which the company has also been collecting. India's largest life insurance company, and September has been the third consecutive month where India's largest life insurance company has seen a decline on the premium front that it collects from its policyholder. So in the month of September, the premium collection was down 27% on a year-on-year basis. In the previous month, that is in the month of August, it was down 35%. In the month of July, the premium collection was down about 47% on a year-on-year basis. Of course, there are reasons as we see it why the premium collection has been dropping or degrowing. The first one is, of course, government's decision to tax long-term savings policies. LIC had a large share in this segment, and now with the taxation becoming effective 1st April, there is significant impact which is being seen on this portfolio, not just for LIC but all life insurance companies, but other companies had something to offset that impact. LIC remain absent in that case, and that impact is more evident here. The second reason is lagging direct and digital sales. LIC needs to transform its digital sales, direct sales. That is one area which the company is yet to work on. A lot of private life insurance companies are increasing their direct and digital sales, which is helping the premium collection there. The third one is, and this was told to us by the management of LIC, that certain premium which was to be collected in the first quarter of FY24 got deferred straight away to the fourth quarter. So in absence of that, the premium collection is also looking weak for LIC. Now, it's not just the premium collection, but look at the market share also. LIC has lost market share of about 1,000 basis points or 10%, on a year-on-year basis. If you look at the month of September, in FY24 itself, the market share is down about 357 basis points. All of this is sort of reflecting in the stock performance as well. LIC, the stock is down about 7% this year. Compare this to some of the private listed life insurance companies. Max Financial is up 32%, ICICI Pru Life is up 18%, HDFC Life is up 10%, and SBI Life is up 5%. This despite LIC being the cheapest life insurance company out in the listed space.
Okay, well, Yash, thanks very much for that. We'll take another quick commercial break here. We'll come back, and we have Jay Bala of cashthechaos.com joining us. Jay, of course, was with us, I think, last week, and he was at that point calling for, a bounce, a 300-400 point bounce, and then, another round of decline. So we'll kind of get an updated view from Jay in terms of where we are. On the index on the Nifty, we are just under 19,700. So holding, there is still 14 minutes to go for close. Stay with us. Okay, welcome back. Jay Bala of CashTheChaos.com is now joining us. Jay, good to have you with us here. Good afternoon. I remember last week you were saying that before anything happens, we will get a bounce, 300-400 point bounce, I think, so a meaningful one. We have that, right? With what we're seeing today, we've kind of recouped all that we lost and a little bit more from yesterday. What's the road ahead?
Yeah, as I said 2 weeks back, see what we saw in September, October is just a preamble to a larger decline. And for that, the necessity condition was a bounce back. So that's what is happening. The resistance for Nifty comes at about 19,780 to 19,888. So, there's a little bit of, a residual bounce probably left for this move. And then we're probably going to see a very sharp decline for the markets come through. And that's probably going to take the Nifty down towards 18,500 at a minimum. So, make use of this rally and, stick to select pockets and avoid leveraged longs.
Okay, all right. Hi, Jay. Good afternoon. Just as the bulls were punching the air and saying maybe Jay is going to be talking about a breakout moment, you spoke about 18,050. So we take that on board on the Nifty. But what about the Nifty Bank? Today, after a while, it's showing some signs of, bouncing back. And after a while, it's outperforming the Nifty as well. What are the levels you're looking at on the Nifty Bank? Because that's going to be the key mover.
That's right, Nigel. Have you seen the movie Hunt for Red October? It's a classic, Tom Clancy's Sean Connery and Alec Baldwin. It's a fantastic movie. If you haven't seen that, see that, because that's what is happening for the Bank Nifty. There's a hunt for Red October. The banking index hasn't had a negative close in October for the last 10 years. The last time it closed in red was in 2012. The avoiding the monthly close being red for Bank Nifty isn't big deal because it's just 200 points away from a monthly positive close. So, but the key supports for the banking index come at about 43,750 to 42,500. So, the relative weakness is coming from private sector banks. If public sector bank starts to cave in, I think we'll have a red October for the banking index.
Jay, afternoon. You want to take us through your call on some individual stocks where there is an opportunity to trade?
Yeah, I'm coming with the one short call and one long. And Sun TV has got a completed move from April of this year. So it's a 5-step move. So it's due for a correction. So place a stop above 639 and expect Sun TV to drop about 560. If it exceeds 560, probably it's going to transform into a bigger correction. And Nifty Auto Index in particular and specific stock escorts is looking decent on the charts. Stop below 3060 and a potential for 4,000 is there. I also like Dalmia Bharat at the moment, but the targets are quite high. But I don't know, if I'm anticipating the market to drop quite sharply, I don't know how it will work out. But, a stop potential of about 2198 and probably, Dalmia Bharat, I'd say my projections come to about 2700. I don't think that's going to be possible, but, it's out there.
Okay. Those are some cement stocks on the radar. Jay, tell us a little bit about IT, because from an event perspective, and that's the next thing the market is walking into. So what are these frontline Indian IT charts telling you, TCS, Infosys? I mean, anything interesting worth noting?
Yeah, TCS in particular has been slightly better off than Infosys, and but today's price action is saying that if TCS were to drop below 3450, that will be a warning sign for the medium term, because this is carrying the elements of a completed move from the April low to where it is now. So we don't want to see TCS drop below 3450 because TCS is relatively stronger than Infosys, and Infosys Wipro are much weaker within the sector. So if this particular stock drops below 3450, that can have a bearing on the whole sector. And as it is, the move for the Nifty IT index is looking corrective rather than start up a new trend.
By the way, Jay, any updated views on oil? Because I think from 98 we've fallen to 86, now around 88. Any thoughts?
Yeah, see, my premise has been that Brent is going to tank along with equity markets, and that this seems to be the start of it. But if we see Brent take out the highs of October, somewhere about 97. I think that's a very dangerous situation, and I don't like it, and I'm not prepared for it. But if that happens, we're going to see a very, very huge rally come through for Brent, somewhere about 200 plus. That's anyway on the cards, but that's for something in 2024-25. But if Brent were to take out 97, we are looking at a immediate move to much higher levels.
Sorry, if Brent takes out 97, then it's headed to
250 plus, but that's a long-term call, not a short-term call. Okay. But it'll be an 18-month move, probably a 12-month move. We don't know, but time is approximate. But that'll be it'll probably mark the low it's registered about 60 odds as the beginning of the move towards $250.
All right, Jay, what about from the metals space? What are you looking at out there? Copper, something you track, I think?
Yeah, copper is looking particularly weak. It last week came within a whisker of its 2023 low. My medium-term projection has been that copper will drop below the 2022 low and head towards somewhere about 2.7 on high-grade copper on the COMEX index. So COMEX exchange. So that I'm negative on copper, and I think this is the start of an accelerated phase of decline for copper.
By the way, we got a big move on the real estate index, Jay, about 4% move here. Any thoughts?
Yeah, this is one of the positive sector, along with probably pharma. Pharma is just languishing at the moment, but this has got potential to scale about 643, 650, about 5 to 6% from now. But that will be a decision point, crossroads for me, because most of the constituents within the sector are showing losing momentum. So this doesn't seem to be, an expanding move, rather than it seems to be an exhausting move. So watch out for what the index does around 643. That's going to be crucial. Watch out for topping signs. If we get topping signs, it's better to get out. But until that point, hold on to the stocks and be long.
What about something like Reliance Industries? It's been a big underperformer since its 52-week high that it hit in July. The stock has corrected 19.5%.
Yeah, that's right. This has been my primary view that Reliance would negatively consolidate between 2100 and 2400, and it's doing that. It's due for a short-term bounce. Probably, if the Nifty were to hit somewhere close to 1988, that that's the maximum potential for this counter-trend bounce. Probably Reliance is going to give a little bit of lift from here and hit somewhere towards 2400, 2420.
Jay, we'll leave the conversation here. Thank you very much for joining in. Counting down to the close, a positive close, a strong close, a gain of nearly 1% on the benchmark indices. The Nifty just shy of 19,700 as it puts on a gain of 180 points. Sensex surging close to about 600 points. The broader markets, which underperformed yesterday, came back very strongly. The mid-cap index up 1.4%. The advanced decline ratio had 7 stocks gaining for 2 in the red. Today, all global equity markets had a risk on, so they've shrugged off the conflict, at least for now. So no panic in the global markets, and there was that up move. The big gainer was Coal India, a 5.5% gain on expectations of high dividends coming through in the second half of the year. Adani Port rebounds 3.5% after yesterday's fall, crosses its 50-day moving average. Bharti Airtel was a big mover, 2.5%, fresh 52-week high. On the financial side, you had Kotak Mahindra Bank and Axis Bank outperforming, and metals had a last 1 hour rally on expectation or hope that China will announce a stimulus. Just 5 Nifty stocks in the red. Notable ones are IndusInd Bank, Cipla, but again, the losses are just 0.3, 0.2, 0.5%.
Okay, let's look at mid-caps, which have had a pretty good session today. The index itself is up about 1.3% with a very strong advanced decline ratio, over 2,300 stocks advancing. So let's find out what most of them were like. A couple of interesting names from the PSU space, both central PSUs and state PSUs. And GMDC stands tall, huge volumes on the stock today, 20% circuit as the day is closing out. And then if you go down the curve and look at the central PSUs and NBCC, IRFC, NMDC, Coal India, these are some of the names. Even some of the PSU banks came back on the screen today on the upside. Central Bank of India, Union Bank. about 4, 5, 6%, depending on which of these PSU stocks you're looking at. So pretty, good session. IOB, MMTC, PFC, good day for PSUs. Beyond that, some other gainers, of course, came in from the real estate market. Let's not forget that. Godrej Properties, Puravankara, Keystone Realtors, Prestige Estates, 7 to 8% higher. So good day for a lot of these PSU names as well. In terms of stocks that were in the limelight today, in terms of news flow, watch out for Mazgaon Dock. Again, some announcements, recent order win announcements, MOUs, that helped the stock 5% higher. And Genus Power, which would be executing more smart metering projects, that was up about 5% as well. So all in all, great day for mid-caps too.
Oh, absolutely. Great day for mid-caps. And, the market coming back nicely after yesterday's sell-off that we really saw. So we're back at decent levels, right? 19,700, almost 19,700 is what we have on the index. Almost 1% in the green. The Nifty Bank doing a little better with about 1.1%, which has been the weaker index. But it's good to see that doing a little bit more, making up a little bit more as compared to the Nifty. Well, I think that's a wrap from all of us here on this edition of Closing Bell. But don't go anywhere. Our Tuesday special, Commodity Champions, will take all the action forward. Stay tuned.